Good morning. We are half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Good morning. Let's get to your top stories this Friday morning. Alibaba in focus this hour after the U.S. listing surging on its AI strategy and also the fastest revenue growth in more than a year. The company is close to becoming China's second largest company in terms of market cap.
And Japan's inflation is speeding up, keeping the central bank on a rate hike path as the yen hits its strongest level against the dollar since December.
And also ahead here in shows, the U.S. Treasury Secretary Scott Bessent set to hold a first call with his Chinese counterpart as he stresses Beijing must rebalance its economy.
Plus, how China's EV price war is pushing out smaller automakers and leaving behind a trail of zombie cars.
Happy Friday morning. Welcome to the show. Hope you're all well. I'm going to try to make it very, very short right now. So we are looking at declines on the benchmark itself. And as you can see the pull coming through across some of the major markets that are opening up right now. Although Taiwan, as you can see, is providing some bit of a counterweight. Mark my word, that red goes away in about 90 minutes or so when you have the Hong Kong markets opening up. The other thing I want to point out is dollar yen. More on this in a moment. The Japanese 10 yields up 8 straight days on that inflation print coming through out of Japan. And again, rate hike expectations are slowly being pulled forward by the markets. And flip the page, please, and have a look at yen and yen pairs right now. So consensus is still, in terms of a full rate hike priced, still towards the latter part of the Q3 this year. That's getting pulled forward to July, June, and maybe even May. Let's see, because Governor Ueda is actually set to speak this hour. So watch out for commentary out of that. As you can see, the yen is slightly on the weaker side of things right now, closer back to 150. We'll get more about on this in just a moment. China overnight. Okay, here's the big one today. Here's the big counterweight. Alibaba, 8% overnight. And also some of the other companies that have come out with earnings too. And some of the e-commerce plays, this is an EV player, of course, also coming through with quite a hefty rally. So just watch this closely. Extremely heavy volumes coming through in Baba, over 120 million shares traded, which is, I think we've only had a handful of days since the listing back in 2014 when we had a similar amount of shares traded as far as Baba is concerned. So when you look at the open in Hong Kong, obviously Alibaba is going to be very much in focus. On top of that, watch the amount of money that's going to come across the Stock Connect today because you don't have that listing onshore, right? A50 futures, and there we go, right? That's the Alibaba effect coming through as well, reflected in these futures. Dollar China, 725. We are still in the window, of course, for MLF, but I guess that's a story for another day. Rebecca.
Yeah, to your point there, Dave, about Alibaba and the e-commerce stocks, it's going to be a really big focus for today's trading. After that really strong performance in the US, we're looking to see whether or not that trails through, particularly when we think about, for example, the HSI. Now, the HSI is sort of basically flat as we go into tomorrow. We did have a bit of profit taking this week. We'll see whether or not that rally resumes. And to your point there, a big part of this story has been the southbound flows. Do we see a kind of strong return coming through on Friday? The other point to watch here is we actually also, on the HSI, we have this review coming up. That's the review that's going to be announced today and then take effect actually in March, so not for a couple of weeks. Dave, I mean, as far as I've seen, I've not really seen any analyst get all the predictions right on what's going to be removed, what's going to be taken. So I'm sort of walking into a trap here. But, the consensus...
Go ahead.
Yeah, the consensus is roughly that we might see the shift away from financials, maybe an incorporation of education, of AI, stocks and so on. But heavily caveat that with we're often wrong. Yeah,
there's no real science behind this.
Yeah, exactly. And to those sort of speaking to that point about some of those strong flows that we've seen, this move away from this move away from bonds into Chinese stocks. We've seen yields edging up a little bit higher when it comes to some of those CGBs. So just keep an eye on that as well. And earnings, just a couple of points to add. We've got Standard Chartered coming through. We've got Sands China. And we are still in the window for the MLF.
Yeah, there we go. Setting us up for what looks to be a hefty Friday as far as the rally is concerned here. All right, let's have a closer look at Alibaba. 8% up overnight. Massive move up, obviously, in market cap. on the PE as well, just a move from 2 standard deviations to just 1 standard deviation below the mean right now. The fastest pace of revenue growth, really, in more than a year out of the company when it reported about, 12 or so, more than 12 hours, but 15 hours back. Let's bring in Belle, who's with us right now to take us through lots to unpack here with a company with so much plot lines involved when you look at the company.
There are a lot of plot lines, but I think that it's also gone on a back-to-basics strategy. If you think about what we've been through with Alibaba over the past couple of years, I mean, we were talking about sort of splitting off the 6 different business units and listing them, and that has totally been scrapped. They've had the new leadership, and they're very much focused on the e-commerce and they're on the cloud as well. So just kicking off with the e-commerce division, this was strong growth here. So coming in better than expected overall, so up around 9%. AliExpress really stood out as the one to watch there, so growth of 30% on the year. So beating estimates. But in the earnings call, it really did take a bit of a backseat to cloud, and that was sort of the primary focus. And the reason we've seen so much market cap being added to Alibaba this year is partially on that AI story. DeepSeek working with Apple, embraced by President Xi, all positive factors for the stock. So cloud revenue up 13% on the year, and the company as well saying when it comes to spending in this area, they're really just at the outset here. Spending over the past couple of years is going to be well and truly exceeded over the next decade or so.
We'd also had these comments from the CEO promising these sort of quite big numbers potentially on capital expenditure when it comes to artificial intelligence. Just lay out what we're hearing on that front and what are we expecting to see?
Yeah, this is really interesting, and I think it's important to create some distinctions here, because as it stands right now, Alibaba is the only major player in Chinese AI that builds its own models, builds its data centers, runs a cloud service, funnels capital into AI startups. So in that way, you can kind of think about it as like a Microsoft in this space. So they're really investing heavily into this area, and they're also making some very big pledges. Actually, what came out in the earnings as well was Eddie Wu, the CEO, saying that they want to focus on AGI, artificial general intelligence. And even though that's sort of a very hypothetical concept at this stage, and something some people would say may never ever be realized, it does again point to how much they're continuing that push into AI.
It looks like we're going to get double-digit gains, 10+%, and indicated higher right now. How are investors? I mean, risking asking the obvious here. How are investors reacting to this?
That's true. Maybe that is. Sorry, Dave. I feel like Rebecca was talking about traps. Maybe I led you into a trap on that one too.
I walked right into that, didn't I? Okay. Well, save me now. Okay.
Oh gosh. Anyway, the point that I wanted to make is that really the analysts were positive on it. Citi, for instance, was looking at the growth in customer management revenue, EBITDA gains in Taobao, Tmall, improving margins as well for the cloud business. They came in better than estimates, so that's a good sign as well. JP Morgan, they've got an overweight on the stock, saying that they showed better than expected revenue and profits across the key segments. And also what's interesting to note is this isn't our reporting, but Wall Street Journal had Ryan Cohen, who's sort of been a meme stock king, ignite explosive rallies in the likes of GameStop, for instance, as other businesses during the pandemic. He's also built up his stake in Alibaba, and what Wall Street Journal is reporting, according to their sources, that he really is bullish on the outlook for Alibaba over the longer term. But yeah, I mean, ADR's there, strong close, 8% up higher.
Okay. Bloomberg tech reporter Annabelle Jewell is there with every twist and turn from Alibaba's earnings. And coming up later on the show, we'll be drilling even deeper, more analysis on the better than expected earnings results that we saw coming out of Alibaba, as well as this broader rally in Chinese markets. We'll speak with CLSA in the next hour about their outlook for each part of Jack Ma's empire. And later, Morgan Stanley also joining us to discuss their recent upgrade of Chinese stocks coming at the expense of others in the region. US Treasury Secretary Scott Bessent says China needs to rebalance its economy ahead of a phone call with his Chinese counterpart later on Friday. For more, let's bring in our China correspondent, Min Lo. Min, just lay out what we know so far about the details that are emerging from this call.
Yeah, so this is an introductory call. Not sure if this would eventually lay the path for a Trump call, which has been telegraphed but hasn't really happened so far. But Bessent has said that one of the top primary agenda here is the fentanyl issue. But the Chinese embassy in the U.S. has responded, saying that this shouldn't be a pretext to impose tariffs, that China has already done a lot, provided tremendous assistance to the U.S. on this front. And granted, yes, China has indeed closed some of the loopholes when it comes to regulations. It has strengthened supervision. It has allowed U.S. law enforcement officials to play a bigger role in investigating these smuggling rings in China. But the U.S. is saying that's not enough. In the executive order, it's written there, the U.S. believes that China has the most sophisticated surveillance mechanism in the world and a very strong law enforcement mechanism. So there is no way China doesn't have the capability to end this fentanyl issue once and for all if it so chooses to. So both sides have very different starting points there. Whether they can come to a compromise is the big question. And of course, the other big issue is the imbalance of trade, given that Bessent has repeatedly said that China has the most imbalanced economy in the history of the world and it's exporting its way out of a recession. His words, not mine.
Just latest on tariff negotiations, so we can talk about other things.
Yeah, well, so the issue of imbalance of trade, whether the U.S. will be getting China to pledge to buy a certain amount of U.S. goods is the question here, and what China can get in return for that. And China so far has signaled that they are willing to de-escalate things just based on the retaliation so far. They have been largely less than proportionate to the scale of the U.S. tariffs. Trump himself has said he's willing to kind of deal with China, but no details yet on what that could mean. And you throw in Ukraine to the mix with Trump, trying to end that war. Does he need President Xi to help with ending that war or assisting in post-war reconstruction effort? Or does this leaning toward Putin actually come at the expense of Trump, at the expense of Xi, because then it would refocus the entire attention of the U.S. military on China and its alleged aggression in the South China Sea and the Taiwan issue. We know the State Department recently removed that phrase that says the U.S. does not support Taiwan independence. That was removed from a fact sheet, although outwardly U.S. is saying it still supports that one China policy. So many moving parts here in that broader negotiation.
Min, thank you so much. Min Lo there, our China correspondent. Yep, so we've covered the top stories going into the open today. Alibaba called substantially higher. And of course, the geopolitical angle to all of this. In fact, just on that very note, coming up here on the show, with President Trump now teasing a new trade deal with China, perhaps, possibly, on the cards. John Quelch from the Duke Kunshan University joins us with his insights on politics behind what seemed to be, is there a method with the madness right now? Right, going into the open today, counting down about 17 minutes away, Shanghai, Shenzhen, and Hong Kong. The Friday session is upon us. This is the China Show.
I think DeepSeek's the best thing that ever happened in China Tech, because my view is that it's just starting this innovation that's going to happen across the whole big tech ecosystem. Whether it's Baidu, Baba, JD, Tencent, however you want to think about it. And we're in a fourth industrial revolution playing out across the world.
Dan Ives there, only he could pull off that comment, and of course
don't do yourself down.
No,
you could come back in a purple suit.
I am looking forward to Monday now. Grace Tam is with us on the note there that the DeepSeek moment is the best thing to ever happen to Chinese tech, and certainly we've seen markets play it out. Grace, good morning and nice to see you. Let's just use Alibaba as as an example here. We're up 60% year to date. What do investors do now?
Yeah, I think especially in the short term, there is still pressure for profit taking, given the upcoming NPC, and we don't know whether there's going to announce any stimulus measure, things like that. So it's better to be profit taking after the recent rally, pretty sharp rally. But in the medium term, actually, for a lot of those China techs, they're actually still pretty cheap, especially versus the U.S. mega cap technology, because for now there is still the very big valuation gap, and we actually expect for example for the China techs, the re-ratings will continue in the medium term, especially to re-rate back to the normalization of the valuations. Yeah.
So overbought, is that the bottom
near
line
term?
here?
Yeah, overbought in the near term, but medium term, actually, any bigger corrections, or we don't know if the NPC is going to be disappoint. So another corrections, and that could be very good buying opportunities.
Yeah. And that's a good point about the risk of the NPC, and we do typically see equities come back a bit and fall back a little bit going into it because part of the uncertainty. What do investors need to see as a bare minimum from the NPC in order to sustain the momentum behind the rally?
I think for the NPC, we're going to see their, announcement in terms of the targets, the growth targets for this year, and also the budget plan. So in terms of the growth target, we think they are going to keep the around 5% GDP growth. But in terms of, I think the focus will be on the budget plan, whether they're going to increase the fiscal deficit. So that could mean whether they're going to do more in terms of the fiscal stimulus. I think that's the key. Yeah.
How receptive are your clients now to the idea of adding further China exposure at this point?
Yeah, I do think with the DeepSeek developments, the sentiment actually turned much better. And I think people are also seeing buying opportunities into especially the China tech areas. Because especially as I mentioned, valuations remain relatively attractive. And also actually for DeepSeek, we can say it is actually a game changer. Because it is going to change the whole AI ecosystem with the lower cost AI models. So we will just see more and more AI adoptions. In the coming future, and so I think especially for now, valuation remain cheap. And also when you look at the earnings, of course we're going to see more earnings results from the tech sector. But I think for now, especially in terms of earnings, actually they're actually not bad. Or there may be potential upside. Yeah.
And what are they? I'm curious to hear how are your clients funding this additional exposure to China? Morgan Stanley's joining us, I think, in about an hour. What they did was they went from underweight to neutral on China, and they took that from Indonesia, for example. So I'm curious right now, if it is China, what are they selling out to build into that?
Yeah, for a lot of our clients, actually, they're still very, cash rich. Okay. So there is still a lot of cash. But obviously, when we look at those fund flows data, we're also seeing a switching, for example, from Japan, India, back to China. Yeah.
I want to ask about tariffs, of course, the obvious question here. Is the assumption that Beijing, no matter what, will replace any shortfall or any hit to growth with sufficient stimulus, or are they going to allow and tolerate some amount of pain here?
Mm-hmm. I think if there is further increase in terms of tariffs on China, I think the first reactions will be to depreciate the renminbi. It's not going to be a big depreciation, but some depreciation to offset. But I do think, as a lot of the government officials mentioned earlier, they're also eyeing to have more stimulus, especially on the consumption front. Yeah.
What about in terms of income strategies? What opportunities are there, whether that's in China because of the fiscal boost, or are yields elsewhere? Have they pushed high enough elsewhere that that's probably a better option right now?
Yeah, I think especially when you look at China deposit, it's actually pretty low. It's just around 1%. Yeah. And I think that actually also a drivers for a lot of Chinese monies to go elsewhere to have better yields or better performance. And we actually think that the Hong Kong equity market is actually one of the beneficiaries. We've actually been seeing the southbound inflows to Hong Kong actually keep increasing. So I think the concerns of the renminbi depreciation and also the really low deposit rate, this is actually a pushing factors for a lot of mainland monies coming to Hong Kong assets. Yeah.
Okay. And sort of perhaps even beyond China, any big shift in your conviction calls and where you're seeing opportunities?
Yeah, we actually recently turned more positive on especially the U.S. Treasuries and also the UK gilt, given the recent spike in yields. So we are taking these opportunities to to turn more positive. And also, for example, like for the U.S. Treasuries, the term premium is actually very, very attractive for now. And also, everybody talk about the Dodge cost cutting, and the Dodge cost cutting actually people will see maybe like in the near futures deficit is going to decrease, and that will cap the upside for the yields. Yeah, so we think this is actually very good. Time to have exposures to U.S. Treasuries, and for our U.S. 10-year yield targets, we are 4.25. So there is still a lot of room for yields to come back down, meaning U.S. Treasuries to go up. Yeah.
Yeah, very nice. So you have carry and the yield on the table there. Grace, nice to see you. Have a great weekend ahead. Yeah. Grace Tam there, Chief Investment Advisor at BNP Paribas Wealth Management here in Hong Kong. Right, the stock in focus this hour, and I would imagine throughout the course of the session, Alibaba up 10% in your pre-market today.
Yeah, and well, we're expecting to take a look also at the HSI. I mean, you came prepared. You're in your trainers already. You were charging ahead into Friday trading, but it does look like we are indicated higher. Yeah, you can say 2.3% on the Hang Seng Index. That would mean that we are in for another week of gains if we stay even roughly close to these levels. We're headed in today basically flat. Yeah,
there we go. 6 weeks of gains. If nothing changes from between now and the close. The opening bell, 7 minutes away, 6 minutes away. This is the China Show.
Good morning. You are watching the China Show and focus very much on the tech names. And of course, Alibaba really at the forefront here, 10% higher. Just noting that overnight in the US stock, we came as high as 15%. We closed around 8%. And also this broader question about whether or not these sort of better than expected revenue results do indicate that we are seeing a recovery from some of those post-COVID troughs that hit a lot of these consumer names, Dave.
Absolutely. And I think Morgan Stanley, Laura Wang's going to join us in about an hour from now. So they've actually upgraded the Chinese market. And I think one of the premise with the Morgan Stanley call is really there's a structural bottom-up approach that's taking place and change that's taking place in China as well. So we did hit a valuation bottom on Chinese markets last year. More on that in a moment, including the open. This is the China Show.
Good morning. Welcome back. You are watching the China Show. We are counting down to the open of markets today, and it's really a tech story. We had Alibaba earnings coming overnight, restoring some of the optimism and kind of restoring a little bit of a kick to the slightly slowing rally that we saw this week, Dave.
Yeah, I mean, we're flat now on the week, so I think that just really is in many ways juxtaposes what the last 5 weeks has been. I mean, we've been talking about this. Alibaba's up 60%. The Hang Seng Tech Index is up 30+%. You know, with the gains today, I should mention that the Hang Seng Index at 2390 is actually within striking distance. Probably doesn't happen today because already up 2.3% of the high that we hit back. I think it was in October, if not already, actually. I'm confusing my benchmarks right now. Now, just to mention that as well, let's have a look at where we are as far as the Alibaba story is concerned and the broader markets too. And wow, check that out, 3.3% to the upside on the Hang Seng Tech Index. So in many ways, if you think about it, we've come full circle, right? So in 2019, when the Ant IPO was pulled, we're now fast forward 5-6 years with a symposium at the start of the week, chaired by the President Xi Jinping, and among in the audience, of course, Jack Ma and his cohorts within the broader tech space as well. It's interesting to juxtapose that with the actual fact in the markets that Alibaba is actually now set to overtake or retake the #2 spot on the China's biggest companies list from ICBC if all things don't change going into the close today. So really how things have shifted back in focus in tech. If you're curious, by the way, what #1 is, that's Tencent, then it's Baba. Right. Very quickly, the open on the mainland is also looking like this. I'd keep an eye on southbound flows just because you have some of the names that are favored right now listed only in Hong Kong as far as the greater China market is concerned. So I think one threshold to watch is 21, 22 billion net Hong Kong dollars across the stock connect. That was the 4-year high I believe we hit earlier in the week. We could, plausibly take that out this week. The other story, though, and just to speculate on these index changes that are probably coming later today. So you have 3 stocks in focus that analysts have put forward as possibly being added to the benchmark, the Hang Seng Index, that's Biogen, that's SenseTime, and that's NEO. So obviously new economy stocks, everything from AI to some of these EV players like NEO, for example. Hong Kong X is on this board, just to mention as well, because obviously you have a rally, you have a pickup in volumes, and you also have some upgrades coming through out of Guosen, bottom of your screens, and also Citi coming up very shortly with their new price targets. So, yeah, want to watch here going into today. But again, Rebecca, it's been so good recently that we almost forgot there's a tariff conversation that we need to have still.
Yes, absolutely. So President Trump unleashing these new tariffs in his second presidency. Of course, it's been gentler, to your point, Dave, than we thought when it came to China, but still really robust response. So we have this very nice analysis from our colleagues in BN of the way that global commerce has been rewired since 2017, showing how we've seen countries shifting their exposure. And I want to look first at yellow. Just look at yellow. So these are the biggest U.S. trading partners, the biggest differences or the shifts in trading that we've seen. And right at the top, Mexico. Again, this sort of shows the extent to which some of these other countries now in the firing line think about those Mexico tariffs. We saw, of course, Canada also up there. And China has come down quite a ways since 2018. Now, if we switch to gears, so look at orange, so that's China's biggest trading partners. Russia right at the top here. And it's really a geopolitical story. It speaks to this sort of economic lifeline that Beijing has become to Moscow since their invasion. An interesting shift for some of these other countries that, are closer politically to the US. So look at South Korea, Japan, and even Germany coming down a ways here. And then, of course, no great surprise here, but the US, quite a shift here again for China. And meanwhile, we also, if we can just flip the board, we can also look at how sort of countries are becoming increasingly vulnerable to some of these tariffs coming out from the US. Look at the top here, Vietnam, Mexico, Canada, and China, again, this sort of dip towards the bottom that we are seeing. So we have someone excellent to join us and help dig a little bit deeper into that story, break down some of those numbers. Let's bring in John Quelch, Executive Vice Chancellor at Duke Kunshan University. And I want to start off with this question on tariffs, John. As a result of some of the tensions between China and the US, we have seen China seeking to expand its export markets elsewhere into the world, including Southeast Asia, including into the global south. And I want to ask to what extent Beijing and China needs to be concerned that these countries, or Beijing might face a backlash from these countries who aren't as willing to accept these excess exports.
China learned a lot from Trump 1.0. China learned that its dependency on the U.S. market made it vulnerable, just as the U.S. was concerned about its dependency on the China supply chain. So since Trump 1.0, there has been a progression on China's part to open up as many new markets as possible. And we see that the relative percentage of dependency on the U.S. trading line has diminished, as Rebecca indicated. So this is a very sensible strategy on the part of China, and quite frankly, I think it's sensible for the global economy that the two biggest economies not be so dependent on each other. Let everybody enjoy the benefits of global prosperity.
Yeah, Professor Quelch, nice to see you, by the way. When we talk about how politics is really what's driving what President Trump does, not so much economics, but it's economics that that determines how companies act. For example, Should companies continue to diversify their supply chains even further? Is that a trend we should expect to continue, agnostic of what happens with politics?
Definitely. I think companies are following countries, David, in this regard. They have pursued the China plus one, China plus two strategy. Makes a lot of sense. What President Trump is obviously trying to do, in defiance, by the way, of the law of comparative advantage, and all economists agree that these tariffs are, from an economic point of view, not a good idea. But what he's obviously trying to do is play to a political base that is looking to restore U.S. manufacturing. And if you look back at what happened with Japan 30, 40 years ago, the end game was that Japanese companies invested heavily in the U.S. and Japanese automakers today, for example, are extremely strongly represented in U.S. manufacturing. You know, that kind of approach emanated that solution emanated from the tariff and quota war versus Japan. Same end game likely to be the objective this time. More manufacturing jobs restored, especially in a sector like the auto sector, which is very high visibility in the U.S. You know, every American's lifestyle is wedded to the automobile, and so people are very sensitive to auto prices and auto choice.
Outside of this quite restrained response that we've seen from Beijing to the 10% tariff threat that we see, are you seeing any other signs or any other evidence that China is taking a softer stance when it comes to the Trump administration 2.0? I'm thinking in terms of maybe trade, climate, people to people.
I don't think so. I think China is very deliberate in its response. Never emotional, never overly aggressive, very deliberate, very proportionate. The U.S. imposes a tariff. China imposes a reciprocal tariff that costs the U.S. as much as the U.S. has cost China. This has been the approach in Trump 1.0. And China's Ministry of Trade and the other ministries in Beijing have a tremendous number of high-quality analysts who have all of these numbers very well calculated to ensure that their response is proportionate rather than provocative. I do think, actually, that it's interesting that Trump has gone after everybody as opposed to just China. Though obviously China has been singled out and is the biggest trade deficit relationship with the U.S. But I think we need to be still a little bit optimistic in the sense that all of these announced tariffs have various deadlines. March 1st for one set, March 12th for another, and then for the overall review of all countries with deficits vis-a-vis the U.S., April 1. So there's still time for negotiation and trading to occur. The negotiations, especially with the larger players like China, are likely to be related to more than tariffs. So we're talking tariffs as the attention-getting device that's used for political purposes to bring a focus on these bilateral relationships. But the negotiation behind the scene may involve a lot of other things. So, as some analysts have pointed out, the objective, for example, of cozying up to Russia to decouple Russia from benefiting from sales of energy to China. You know, that is a geopolitical issue that may be underlying the overall game that's being played here on the tariff front in public.
In terms of just alliances, the Global South, for example, is one exercise that we talk about as well. The Russia conversation that you brought up right now really, I guess, in many ways complicates where we extrapolate that relationship to go. Do you expect those alliances to translate even further into trade ties?
Yeah. So the Global South represents a very significant opportunity for China. I think China, over the last 10 years, has really done a thorough and concerted job of trying to bring the Global South to the China trade orbit. And to be fair, pretty much not a week goes by without President Xi Jinping is welcoming another global South leader to his Beijing office. So I think that China's strategy has been very good on the global South. The problem with the global South is that it's still not enough trade and still not enough opportunity to compensate for any loss of the U.S. market. And it won't be for many years. So it's an important diversification, but it's not a sufficient diversification.
That's a significant point on the need still to have this exposure to, of course, the US market. Give us your sense of the sentiment on the ground for Chinese firms. Yeah. Are they looking to expand into the US? And how are they navigating facing this increased spotlight and increased scrutiny if they are there?
So I think Chinese firms in the US are trying to hide from cover. You know, really, TikTok is the only Chinese entity, and of course that's largely an American investment, the only Chinese entity that has really come out fighting to defend itself. Most Chinese firms in the US are trying to be very low-key and try to stay under the radar. And of course there is a large number of Chinese firms that are still listed on the US exchanges in addition. So I think Chinese firms still looking seriously at the U.S. market, trying, of course, to de-Chinese themselves, if I can put it that way, in terms of their management, in terms of their governance structures and so forth, but nevertheless trying to remain in the U.S. market, because for some of these companies in the higher technology space, the U.S. is the principal customer, the principal market in the world for what they have to offer. And in addition, in many cases where the largest level of talent is from which they can draw expertise for their management teams.
What about, I just want to leverage on your experience and obviously your current position within the educational space in China. Of course, we know each other from a different institution, of course, and Rebecca was also a student in the mainland. How are people-to-people exchanges looking like within the educational sort of system? And yeah, Rebecca, why did you point out as well?
I'll pick up a little point here. I mean, as you know, there was also this report from Kunshan students that they were on a trip to China and they felt themselves sort of overly subjected to Chinese state media. They sort of said that they were perhaps at risk of being tools of Chinese state propaganda, which does show one of the sort of hurdles or one of the challenges when we're talking about how to navigate the sort of people-to-people exchanges.
Well, I'm sort of a big believer in people-to-people exchanges. I'm an internationalist and always believe that cross-cultural communication is the core to sustaining relations that can contribute to peace and prosperity. So that having been said, I thought myself that President Xi Jinping's 50,000 American students to China challenge was an extremely worthwhile objective. Because there was no doubt that during COVID, the American presence had reduced itself, not just in terms of students, but among executives going home to the U.S., etc. So we took it upon ourselves at Duke Kunshan University to make an effort to contribute to that and brought over around 70 students from the undergraduate students from the U.S. for what turned out to be a wonderful 10-day immersion in Jiangsu province this past year. In addition to that, we have around about a third of our international students coming from the United States. So these are people who in the face of all of these U.S.-China relationship problems, are still signing up for a 4-year undergraduate program at a Chinese university. Of course, we also give a Duke University degree as well as a Duke Kunshan University degree. But we are very focused on our role as a bridge between the U.S. and China, and during this difficult time, doing our best in terms of students as well as faculty members and staff members to have some small contribution towards the people-to-people exchanges you talk about.
Professor Quelch, it was great to see you.
All right.
Let's do this
good,
again
David.
soon.
Thank you.
Yeah.
Thank you, Rebecca.
Professor Quelch there, my former professor, and of course former dean as well, where I studied. Executive vice chair, of course, chancellor rather, at Duke Kunshan University. Okay, a couple of things to note. Why don't we start things off with this massive move up in shares of Alibaba. We're up 10%, 16 minutes into the cash market session. 133, who would have imagined that, right? 6 weeks back. If someone told you Alibaba would be at 133, they would call you crazy and tell you to go home. Yet, here we are, and how quickly things do manage to change, don't they?
Yeah, well, talking about change, or perhaps not, we did have these lines as well breaking now from Ueda. We have Ueda speaking in Parliament in Japan, of course, saying that, the BOJ would buy bonds nimbly, that's his word, I believe, if bond yields rise sharply, and comments that it's hard to say when exactly to conduct these sort of bond operations in advance. So we'll bring you a little bit more on that story as the details emerge. Good morning, you're watching the China Show, and now we're looking at an EV, China EV story, Dave. So dozens of small car makers are quitting China's EV sector, unable to cope with an ongoing price war. That's leaving a growing number of obsolete or zombie cars on Chinese roads. For more on this story, let's bring in Bloomberg's Asia Global Business Managing Editor, Rachel Chang. I mean, Rachel, just want to start off trying to understand, I suppose, the scale of the problem. When I was in Beijing, I remember that moment when everyone switched to rental bikes, and there were just, there were just bikes all over the street at one point. So how big a problem is this issue of zombie cars?
Right. I mean, it's difficult to put a number on it, but we do know that at least, dozens of EV makers have gone out of business in the last couple of years alone. So you're looking at thousands, if not hundreds of thousands of cars on the streets with this problem. But of course, the group of, passengers who are really holding on to their EV cars, although the maker, has gone bust, is a small proportion of that. A lot of customers have, upgraded to the biggest brands like BYD, for example. But we did manage to talk to a group of passengers who are essentially driving these cars that, are essentially obsolete, right? The Bluetooth keys don't work. The in-car streaming doesn't work. Maps don't update. They can't go anywhere really to fix these cars. There's a thriving sort of black market that has cropped up online to exchange parts, components from makers that no longer exist, essentially, to keep these cars running. So it's just another one of those quirky, bizarre sort of consequences of the way that China's EV market has really just gone huge and also then streamlined equally quickly.
Yeah, and Rachel, number one, with the subsidies in place and already at the price point these cars are offered, for example, what does this story tell us about how we need to be thinking about the replacement cycle within the EV space, and really in contrast to what we're used to in terms of gas-guzzling vehicles, for example?
Yeah, I think a lot of the EV cars were very much, focused on the smart tech of it. Everything was connected, right? You could connect with your phone, you could open the car with your phone. So a lot of this is very different from gasoline cars, and it does make it really paramount that the company keeps operating, right? Like Tesla, for example, when we say Tesla's recalling cars because there's been a problem, it's not an actual recall. They're just sending a fix over the air. It's like updating your iPhone software system. So, it's good and it's bad, right? And in China, we're seeing the downside of it when that cycle of just, huge investments, so many companies coming, and then, of course, this crazy price war. The EVs in China are just so cheap, and, the giants like BYD really just, at the moment, being one of the last ones standing, and really taking that model of super cheap, super efficient, super innovative across the world. And so, I think what's happening in China is definitely something where we're seeing really the forefront, the edge of what that EV cycle really looks like.
Rachel Chang, our Bloomberg Asia's Global Business Managing Editor there, of course, on just a fantastic piece, really digging deep into the specific unexpected twist, if you will, to this really success story as far as the EV story goes. Right, I'm just looking at markets right now going into the weekend. These cash equities, as you can see, bid substantially. More on that in a moment. This is Bloomberg. Right, for a look at markets going into the weekend. So 30 minutes, almost 30 minutes to the session here. So, we talk about the Alibaba and the AI story, obviously underpinned by the earnings. Don't forget, there are other names there, and there is a government report and some news here, a promise out of the government to further support consumption, including service and tech. And in case you don't recognize some of these names, these are also some of these AI tech plays in focus too on the Chinese mainland. Yeah. Take a screenshot. I know you want to. And then you can revisit that later on. Right. Underneath the hood, Hang Seng Index, Alibaba leading these gains to the upside of a 9%. We're better by 360 points on the benchmark, just under 23,000, that 23,000 level. So we're just coming off highs right now. Plenty more ahead. This is Bloomberg.
Good morning and welcome back. You are watching the China Show. We are about half an hour into the session, and here's a look at the the Hang Seng. Yep, 1.6% higher. Does that? Yeah, so that just about takes us to close the week higher there, Dave. We were kind of going in today fairly flat or so, and really the story is, of course, all about Alibaba earnings and potentially also whether or not we see signs that the Chinese consumer is, coming back a little bit into this market.
Yeah, well, they better, because if they don't, then this rally is probably going to hit a wall very, very soon. At some point, a few weeks back before the DeepSeek moment, we were talking about how this rally would be looking for earnings and an economy that hopefully would be inflated at some point as the next catalyst. And, we're looking ahead to the NPC, and obviously we have the DeepSeek moment, which Dan Ives out of Wedbush earlier on said was the best thing to ever happen to Chinese tech. And certainly when you look at the markets, if you're waking up right now and wondering why Alibaba is trading at 130 and not $80, it was because of that. In fact, let's have a look at Baba right now in the cash market. So we're just about 9% to the upside, 132. NetEase and Bilibili also out. Well, Bilibili was out with earnings that also came in higher than expectations there. Let's dig into the numbers and get to the top story immediately right now with Belle, our tech reporter, who's here with us on set to break down what stood out to her among the numbers here.
Well, there was the two main focuses, I guess you could say. There's the e-commerce division, and then there's also the cloud business, and these were really the priority numbers going into the earnings. But essentially, strong on both fronts, and this was exactly probably the kind of results that we needed to see, given all of the anticipation and the trading activity that we've had over the past couple of weeks, the amount of market cap as well that's been added to the stock. But here you can sort of break down the figures. Taobao, Tmall revenue really outpacing estimates here. Again, some stronger consumer signals perhaps, but it's also a really clear indication that push back to the basics of the business is paying off, and this is under the leadership of Jiang Fan, speaking on the earnings call for the first time ever, someone who's very much a rising star within the business as well. So strong on that front. Cloud as well. This was really the one to watch, given you've had all that anticipation around DeepSeek and the moves that AI or Alibaba is making into AI rather, but cloud revenue growing at a better than expected 13%. That's the fastest pace of growth that we've seen in 2 years.
We also had some details from the CEO on the expenditure that he's expecting to see when it comes to supporting AI infrastructure. I mean, what is the company doing when it comes to artificial general intelligence?
Yeah, I'll start about the CapEx first, because that was interesting to note. I mean, they've significantly ramped up their capital spending from a year before. So CapEx for the December quarter was $4.35 billion. That was 4 times as big as the budget for the same period a year earlier. So significant spending there. It's interesting to contrast, I guess, to how much big tech in the US is sort of almost being punished at this point in time for heavy spending on AI continually. But it's a different story, perhaps, for these Chinese tech names. And the market is clearly interpreting in a bit of a different way, because investors are very optimistic about how much the company is seeing further potential in AI. AGI as well. Yes, that's what CEO Eddie Wu said that they want to be able to achieve. That's their primary objective, he said. I am curious about that one, just on the point that AGI is something that many would say actually isn't even possibly ever realistic, or something that's perhaps decades away. But, I mean, maybe we can get more on that now, Dave.
Yeah.
Or in this conversation, I guess I gave...
Well, we have a really good resource speaker to tell us about this and really give us insights on this. So CLSA just raised their price target for Alibaba ADRs. Head of Asia Telco and Internet Research, Elinor Leung, is here with us. And so, Elinor, it's very nice to see you. We mentioned there at the very top, you raised your price target. I think it's 165?
Yeah.
On the ADRs. It's worth mentioning to our viewers that you guys, before this, just 3 weeks ago, raised the price target from 80 to 122, 120, 125, and then just now to 165. How did you guys come up with that number?
Right. We see a very meaningful improvement in both e-commerce as well as the cloud business. We think that is an inflection point of the cloud service provider in China right now. So if you look at their last quarter results, their e-commerce business now can regrow at 9% because of the increase in GMV, because of the increase of take rate for the company. GMV is boosted by change of the policy from the Chinese government, and the take rate also increased because they're improving ad efficiencies, the growing adoption of their Choong, which is an omni-platform marketing solution, as well as they introduced a 0.6% technology service fee there. So we think that is likely to be sustainable going into 2025, and also because of the strong top-line growth, they can regrow the e-commerce profit in the same quarter as well. So that's get people happy about it. And also AI is the big thing because their cloud service provider, cloud service revenue is accelerated to 13% year-on-year, the first time resumed to the double-digit growth for the company because of the strong AI product demand, which is growing triple-digit in China right now. And remember, this is in 4Q, meaning this is before DeepSeek. Right. So China AI actually is happening before the DeepSeek. This will just accelerate the growth.
How did the narrative, or how did the sort of fundamental investing case around AI, it seems to have changed relatively quickly. I mean, if you go back to last year, the main sort of theme or story around AI in China was the lack of propensity to pay for AI services. So how is it looking different for Alibaba?
Actually, the momentum already built up in China in AI last year. Maybe not a lot of people are aware of it because originally a lot of the internet companies worry about they are not being able to access the advanced chip in the US. But later part of the year, they less worry about that because they think that the performance of the server cluster is more important than the performance of the single chip. So they're able to create high-performance server cluster by using lower performance chip from multiple suppliers and make it as a high efficiency. So they're able to have these high performance server cluster as well using the lower performance chip. And second is that they try to lower the computing power by using smaller expert models, by rounding the numbers in the calculation, by using reasoning model in order to upgrade the performance of the model. So you can see that China model training cost now is only 1/10 of the US, but it's not just the training cost. Inferencing cost in China last year dropped more than 97%. Which is because of the scale benefit. So the inferencing cost in China also dropped to 1/10 of the US. With the training cost, with the inferencing cost at 1/10 of the US, that actually trigger a widespread of AI application creation, which already start happening in the 4Q of last year before the DeepSeek. Of course, when DeepSeek come in, and that even trigger acceleration of the AI application creation. So with the low cost benefit, we actually see that China could have the world's largest number of AI applications in the future, just like the mobile app. And cloud service provider actually is the best play for China in AI because you're going to train your model on their platform. After you train the model, you create the AI application that will also run on the platform.
So do you think that's sort of why the market is maybe also interpreting the CapEx spend a little bit differently to its interpretation of CapEx spend for big tech in the US?
Yeah, I think why market get excited is that China never run on AI. So this is the early stage of the run on terms of AI. And also there's actual revenue generation from the AI and the capex investment in China, which if you look at Baba case, is up 140% last year. And this year probably up another 60 to 70%. But if you talk about capex to sales ratio, China is still at 12.5%, low teens percentage, versus the U.S. internet giant, which is all well about 20%. So the investment return for the cloud service provider in China looks like a lot more reasonable compared to overseas. And that's why if you look at Alibaba, they are not just growing the cloud revenue, but they're also growing the cloud margin. So the cloud margin further improved to 10% in the December quarter because the AI product actually has a higher margin compared to traditional product. So that's why people are less worried about the capex investment for the China internet companies.
The focus on AGI and Eddie Wu saying that that's the primary objective. Does that concern you at all? Only, just as I said earlier, some would say that that's sort of hypothetical, really, at best, or maybe even unrealistic.
I think everybody will use that as the ultimate goal, but when we are going to reach that, it depends on the technology evolution. But even from now to the AGI, there's still a lot of things you can do in China. Why China can have so many AI applications is that not everything has to run through the big model. So they spend a lot of money to train the big model. They dump it down to the smaller model and make it a lot more affordable for the enterprises. So in the U.S., if you invest $500 billion USD, you have the best model in the world, no problem. But how many companies can afford to use that model? But in China, the goal is not just allow the internet company to use the large language model. They want every single enterprises be able to use the large language model. So they're not just providing the large model, but they're also providing the small model. Simple task and jobs, you can go through the small models, and even SME is able to use that. So that's why we say that there will be a widespread adoption of the AI application, and all these will have to run on the cloud. And Baba is the largest cloud service provider in China. They probably will benefit the most. They're also the largest open source large language model in China as well.
Can we use the same logic that this also benefits other cloud companies in China, for example, including, by the way, the SOEs, by the way, and that's I guess in something that's emerged recently as really a camp that a lot of the private sector cloud companies have had to contend with.
Yeah, absolutely correct. It's not just benefiting Baba, it's a widespread beneficiary. So if you look at Baidu result, their cloud revenue growth is 26% in December quarter before the DeepSeek. And then Baba is growing 13%. Tencent doesn't announce the number. I'm sure they're also benefiting from that as well. It's benefiting everybody. But we do believe that the internet cloud service provider will benefit more than the Chinese telecom cloud service provider because they have the chip, they have the technology, they have the scale, and they have the application. So they will regain market share in the internet era. And also, who are the early large language model adopters? Is the internet company, finance company, EV company, which cloud they're going to use? Probably the internet cloud over the Chinese telecom cloud. So we think that the internet company will benefit more over the traditional SOE like China telecom cloud.
Yeah, I think Belle, before you ask the last question, just very quickly here, Alibaba's sitting, I think, on $100 billion in cash. Are you worried that they're sitting on too much cash right now?
Yes, a lot of people want them to return the cash, but they also very proactively return the cash. Last year, they returned 10 billion USD cash, and now they're selling in times as well as SunArt. They get another 3 billion USD cash, and they can continue to do the share buyback in 2025. But of course, that depends on the share price. If share price run 60% year to date, maybe they will slow down in terms of the share buyback. But they are very committed in terms of shareholder returns.
Ahead of the earnings, one of the other really positive factors was this sort of embrace by Alibaba, Jack Ma at the top levels of leadership, President Xi. Some would say, and people that I've spoken to in China would say that the symbolic moment or power of this really can't be understated. What's your take on that, or the reading of it, and what does it mean sort of for the broader private sector, specifically for tech in China?
I think there's a change of attitude to the government, and maybe they finally figure out that, oh, China's enterprise is very strong overseas. They see the result, like in the gaming side, we have Dark Wukong, Black Myth Wukong, and then we have Tuimu doing very well, we have EV doing very well internationally, now we have DeepSeek. And they're finally thinking that, oh, the private company, Chinese private company can be very strong in the tech area, can be very innovative, and we can export this technology overseas. So I think the government now is actually turned positive or supportive to the private private sectors and internet companies. And if you remember that in the past, China internet companies trading over 20 times PE, but it dropped to low teens because people worry about China economy, because they worry about the crackdown from the government, or worry about China doesn't have AI. But I think two of these three overhang already been removed, and now P multiple can be raised to more normal level, because if you look at Alibaba, Tencent, they still can grow like 15% or even higher forward. They should be able to trade higher multiples.
So what's normal? So we're at 14 times now. Before this all happened, we were trading north of 25 times. So you split the difference, that's about 20 times. What's a normal multiple that we should be attaching to these stocks now, given that if the premise is correct, the crackdown is over, do we return to that?
Tencent used to trade over 20 times PE, and Alibaba used to trade like high teens percentage PE. They grow slightly slower compared to Tencent. I think that is doable. In the past, during the trough of the China internet sector, you can see they are trading at PEG 1 times or even 0.9 times PEG. Why not, in the historical level is 1.1, 1.2 times PEG. So I think the P multiple will be able to re-rate if people less worry about the growth prospect of these companies.
This is where I wish I had a podcast that was very long so we could talk with you more. There's lots more to unpack here. I think maybe my bosses might be listening to this. Thank you so much, by the way. Elinor, have a good weekend ahead. I'm digressing there. Head of Asia Telco and Internet Research at CLSA. Right, for our Bloomberg subscribers, you can catch that interview with Elinor and others that you might have missed here. TV Go. It's a function you run. Catch it on your terminal. Yeah, well, check it out. TV Go. This is Bloomberg.
Good morning. You're watching The China Show. Just taking a look at how the yen is trading. Essentially, we're seeing a little bit of a pushback after really strengthening. And it's all about the commentary from BOJ Governor Ueda, seemingly to suggest there is some amount of concern that yields have gone up a bit too fast. Something of a warning for traders here, Dave, when it comes to, I suppose, being too enthusiastic about pricing in that aggressive tightening from the BOJ, perhaps.
Yeah, this is just, what's that boy band? Not just yen direction, yuan direction. Okay, let's get some context here, shall we?
We have Bloomberg's MLive strategist, Mary Nicola, joining us from Singapore with hopefully no more bad boy band analogies here. Mary, something more sophisticated.
Promise.
What are we seeing from investors as they react to the yen today and react to Ueda's commentary?
Yeah, there's been a bit of pushback, obviously, from Ueda because he has seen a rise in yields. And, of course, traders are getting excited about the prospects of more BOJ tightening. And it's hard not to, especially when you see CPI data coming even stronger, cementing the idea that the BOJ is going to continue tightening. And, of course, when you see the CPI data that we saw today, coupled with the PMI's data as well, it shows that the economic outlook is being realized. What the BOJ wants to avoid is any sort of aggressive move, similar to what we saw in August of 2024. So, of course, we're going to see a little bit of pushback. But if you think about it and what's the longer-term trajectory and what we've been hearing from the BOJ is that as long as the economic outlook is realized, that they're going to continue tightening. And that's, I think, what we should focus on over the medium term.
Okay, so suffice to say, I don't need to worry about any potential carry trade unwind a la August 2024?
For now, no, because what we've seen so far has been a very gradual move, in my view, of the yen appreciation since the last BOJ hike, and it's been very much tempered. Of course, it's been supported by a drift down in U.S. yields as well. But of course, when you're looking at how the economy in Japan is unfolding, whether we saw the GDP data, CPI data, and of course, if we look back at the GDP data and see the deflator is an indication of homegrown inflation, and we've seen that been consistent for the last 2 years. So that just suggests that there's more tightening to come. Of course, it's all about the pace. It's all about the pace of tightening, and that's going to be gradual. But it also, the BOJ wants to see how the yen is going to react to these moves. And as long as the gradual moves, then that's likely to persist. And we're not seeing any sort of real carry trade unwinding that we saw back in August of 2024.
Gradual, Mary, is not something we can attribute to this move up in Chinese equity markets, and just to use that as a pivot point. I mean, I don't know. I'm struggling with just a question right now. Just how do I need to be looking at this with Alibaba up 10% on top of the already 50% rally?
Oh, there's no question that there's been an absolute frenzy and excitement over what we've seen in China stocks. And of course, we've seen these incidents before, right? We saw it in September 24 after the policy pivot where people got excited. And a lot of the times it's because investors dismissed China for such a long time. And so now it's really coming back into focus. But I think this time, and I hate to say this, but it could be different in the fact that it is rooted in innovation. But what we need to see is for a lot of the earnings to come through. BABA was one evidence of that coming in the supporting it with fundamentals. So now we need the rest of the tech to really step up and show that there is fundamental support. But in addition, I think investors are still looking for some stimulus. That's really going to add to the longevity of this rally. So you need a combination of strong earnings and more stimulus to show that the economy is really recovering and to show that EPS growth will continue. If we see consumption pick up, if we see the economy recovering. So that combination really can add to the sustainability of the rally.
It's interesting, Mary. Yeah, that key combination there. And we're counting down, in fact, to the MPC, where we may or may not see some amount of stimulus. Bloomberg M-Live strategist Mary Nicola there. Thank you for joining us this morning. There's plenty more ahead. Keep watching. This is Bloomberg. Good morning. You are watching The China Show, and some of the corporate headlines that we are following this morning. Norinchukin Bank has widened its loss forecast and named a new chief executive as the Japanese lender tries to recover from its foreign bond investment debacle. CFO Taro Kitabayashi has been chosen to replace Kazuto Oku as CEO from April 1st. Nochu now sees a loss as high as $12.7 billion in the year ending March, but expects a return to profit next fiscal year. Walmart is forecasting lower than expected profit for the full year, a signal that the world's largest retailer isn't immune to global economic and geopolitical risks. The company also cites uncertainties related to consumer behavior as a reason for its cautious outlook. Walmart's guidance does not include the potential impact of tariffs, which remain a big question mark for retailers. And Rivian shares jumped in late trade after the EV maker posted its first ever quarterly gross profit to close out 2024. The fourth quarter figure of $170 million came in well ahead of Wall Street expectations. Still, Rivian's guidance for unit sales this year was below estimates as changes to tariffs, EV tax credits, and other policies may impact turnover.
Right. Just some other news taking place across these markets right now, so we can set aside, I think, the China tech story for now, just the next few minutes. Korean steelmakers, as you can see, are having a fantastic day. And the cash markets, everything from POSCO Holdings to Hyundai. On the back of this, well, the government is seeking, and I think it's sort of forward-looking and I guess TBC, tariffs on China. So South Korea's Trade Commission said on Thursday that it has preliminarily decided up to 38% anti-dumping tariffs on some Chinese steel plates. A final decision will still be made by the finance ministry.
I mean, to the point we were talking earlier about these charts that show whether or not all the countries that are at risk of sort of facing a backlash when it comes to China dumping products.
Okay, yeah, plenty more here on The China Show.
Especially in the short term, there is still like pressure for profit taking, given the upcoming NPC, and we don't know whether there's going to announce like any stimulus measure, things like that. So it's better to be like profit taking after the recent, rally, pretty sharp rally. But in the medium term, actually, for a lot of those like China tax, they're actually still pretty cheap, especially versus the U.S. mega cap technology.
I think there's a change of attitude to the government, and maybe they finally figure out that, China's enterprise is very strong overseas. They see the result, like in the gaming side, we have Dark Wukong, Black Myth Wukong, and then we have Tuimu doing very well, we have EV doing very well internationally, now we have DeepSeek. And they're finally thinking that, the private company, Chinese private company can be very strong in the tech area, can be very innovative, and we can export this technology overseas.
Yeah, I think Chinese markets are somewhat back in focus recently. Meanwhile, though, and as you can see on the right, on the left is what we're doing right now in markets. A lot of that, of course, is the additional oof coming out of the BABA earnings overnight. And, of course, Morgan Stanley this week raised their targets on MSCI China from 77 to 85, and some of the other benchmarks there as well to 24, and Hang Seng China to about 8,600. Now, they do believe a structural regime shift is happening within Chinese equities, especially in the offshore space. Let's bring in Laura Wang, Chief China Equity Strategist at Morgan Stanley, to just help us understand really what's going on here. It's nice to see you. Let me start with a very simple question. What has changed structurally that we didn't see as recently as, let's call it December 31st?
That's a very good question. You know, we, for a very, very long time, we've been holding a relatively cautious view towards China. But when we see structural shifts coming, we want to be really pounding the table and let investors know about that. We think there are two very major changes are happening in the China equity space, which global investors may not be able to yet catch up with. Number one, there is a very significant quality improvement for the ROE for China equity market. If you look at MSCI China, the ROE for the market index actually had effectively troughed in middle of 2023 and has been gradually catching up with the MSCI EM ROE. And what has caused that improvement? Actually, there are multiple reasons that investors may not have really realized. Number one, it's basically the very diligent self-help effort from the high-quality companies and the shareholder return enhancement activities such as share buybacks and paying higher dividends, etc. That's been going on for the last 12 to 18 months already. And then the second reason is the composition of the equity space in China has been going through a gradual shift, with these high-quality, highly diligent companies taking up much bigger market share versus the sectors that are highly cyclically correlated and being dragged by the deflation environment. I'm specifically referring to sectors such as properties, materials, and conventional industrials. So collectively, they are now representing less than 10% of MSCI China's universe. So that's a very structural shift. And number three, I think basically the technology breakthrough that's happening in China right now, and which has pretty much caught everybody off guard. We think there's more monetization opportunities and potentially productivity and efficiency improvement that could be brought forward on a broad basis. And China has significant leading advantage when it comes to the adoption phase, with its very deep pipeline of engineers, its very well-established ecosystem enabled by the hyperscalers, and basically very good access to data and then support from the government from a regulatory environment perspective. And then I guess on the valuation side, it's a big deal. for the last 24 months, we see MSCI China being traded somewhere between 8 times to 10 times forward PE for good reasons, deflation, tax restrictions, and geopolitical tension, etc. But just over the course of the last several weeks, things are making a big improvement. First of all, the potential ceasefire between Russia and Ukraine has significantly lowered the equity risk premium for China. And then the symposium that just happened on the past Monday sent a very loud and clear signal to the global investors that the Chinese government is affirming the private sector as a central pillar for economic growth. So that's a very big signal that we should pay attention to. And again, last but not least, the technology breakthrough. I think this serves as a wake-up call to global investors that China can continue to not just participate, but also to lead in the global technology competition. So this will improve China's investability assessment and also make investors to reappreciate China as a investment target, as a growth economy.
Yeah, there we go. I think since you mentioned technology and the importance of AI actually would have been very helpful. I just need to correct myself. I know I seem perfect. I'm really not. This is a good example of that. So just to correct what I said earlier on, the MSCI target from Morgan Stanley was from 63 to 77. I will not name the bank that has that 80-plus target on MSCI China. But you know what? We're human. We're not AI. Go ahead, Rebecca. You have a question.
Let's talk more about human risks here.
Yeah, why not?
And let's talk about President Trump. So you're talking about a structural shift behind this call. To what extent are tariffs a risk? And do we assume that the developments in AI and tech, do they offset the risks from tariffs?
So we're not saying that geopolitical risk is entirely going away. That's definitely not what we are saying here. So far, I think it's the overall global geopolitical environment improvement that's serving in the favor of China for the time being, right? So we want to see further incremental bilateral relationship improvement between U.S. and China specifically. So far, what had happened is the reciprocal tariff proposal from the U.S. side, which seems to be targeting a lot more trade partners with the U.S., whereas at the beginning of this year, global capital market was looking at China as being singled out for tariff pressure. So I think things on the Delta side, on the margin, is definitely serving in China's favor. But for example, from here onwards, if the bilateral relationship between U.S. and China can improve, and what could signal that? For example, the two presidents meet, and if some of the existing tariffs or the tax restriction can be removed or alleviated, that would make us further incrementally more positive. And of course, we are not changing our macro view on the deflation side. We are still saying this year for the entire China economy, it's likely to deliver just a slightly above 3% nominal growth. So we are not forecasting a very significant earnings growth improvement at this point. So any earlier signs than we originally expected in terms of China getting out of deflation, that will also make us a lot more bullish than where we are now. But structural improvement, very significant, underappreciated by the global investors. This is the signal we want to tell the capital market, and I think investors should really pay attention to this structural shift.
That's the message. How receptive is the audience, though, to that? The foreign investors, who's buying into this rally? What are the conversations you've had this week?
I think I see a very clear sentiment improvement. Frankly speaking, so far, the rally has happened very, very fast, effectively since late January, right? So we're not even 1 month into the recovery rally yet. And based on our analysis, the data shows a lot of the incremental liquidity actually has been coming from the southbound flow. Yeah. Year to date, already $25 billion worth of southbound flow has come to Hong Kong. And then the local, more regional and China dedicated funds have participated a lot. But if you look at the active funds or the passive funds based in the US or in Europe, they have not really participated at all. I think the change on the geopolitical front and the breakthrough of the technology innovation happening in China, and also the symposium, which only happened 3 days ago. Yeah. So I think it's just happening too fast. Investors are still very much underweight on China, so there's ample room for them to increase their allocation from here.
When you talk about pounding the table to sort of get this message out to foreign investors, to what extent are we talking about a slightly different cohort these days? I mean, is the assumption that we're not going to see US capital or long-term US capital returning in droves? This is more about European capital, the Middle East and so on?
I think it's less about geography sort of division because over the last 24 months, we have seen U.S. investors participating in a number of short-lived rallies. Mm-hmm. I think it's the nature of the investors that we need to pay attention here. The previous rallies, I think for a few times, it was purely driven by the relative cheapness of China, but we thought the cheapness had good reasons behind those, so we have always been skeptical about these rallies, and they turned out to be short-lived, right? Mm-hmm. And there was some speculations around policy direction shift, which you know, Morgan Stanley has always hold a relatively more moderated view towards how much government wants to put in terms of fiscal and monetary stimulus. But this time, I think what we want to see would be longer-term long lease and more strategic allocation to come back into China, whereas the previous rallies, I think, for U.S. investors who actively participated, what we saw is the hedge fund crowd and the macro funds who tends to capture the macro signal earlier. But this time around, it's more bottom-up, it's more structural, which may not be fully appreciated yet by them. So we want to see longer-term money, more strategic allocations from a top-down perspective.
I'd like, in fact, if you could just explain that even further, this micro bottom-up self-help mechanism, because it's not a macro story. What does that mean? What do I need to look out for on a sort of micro corporate level if these conditions can continue?
Yeah, a few checkbox can be ticked, right, over the last 12 to 18 months and even for longer period than that. What we mean by self-help is what companies are trying to increase their earnings growth and to enhance their shareholder returns, even during a very tough macro environment. What they have been doing, particularly led by the large internet companies and some of these high dividend yield companies, is they try to cut costs very, very aggressively. And they try to increase their share buyback plans, and they make it very clear to their investor universe. And then they continue to pay very stable dividends. So the stable cash returns for investors in a very volatile and deflationary environment had been proven to be very reassuring. And so these stocks, for example, Chinese banks and the large internet companies as a sector, they actually have been outperforming the broad market. So that's what we mean by self-help. And we expect this trend to continue to happen because the investor universe has been very well educated that the Chinese corporates as a whole have already embarked on this journey to enhance shareholder returns instead of purely going after growth at a very high speed. So there is quality improvement on that front as well.
Okay, so if we think about the micro bottom-up self-help story, what role does the MPC play in that, if any?
Yes, we actually have a relatively moderated view going into MPC. We're not expecting a bazooka kind of a fiscal package to be announced at MPC. What we expect is about 2 trillion RMB worth of fiscal package that will have certain dedication to stimulate the consumer spending and also with more effort to continuously boost the infrastructure construction. And we do not expect a very major stimulus to the property sector at this point. So I think, this is not a major part for our upgrade call. Again, this is not a bet on macro policy shift from the government side. And this is why we are more convinced and we have higher conviction this time about China going back to the center of the global investment universe and also gaining more conviction for longer-term sticky money, strategic money to come in and reassess China's investability as a global technology leader, as a global investment destination target for stable shareholder returns. Those will be what keeps the investors in China market for longer term.
So 2 trillion yuan, and that is quite a modest view that you're taking to expect from the MPC. But do investors, I'm thinking particularly, in fact, both foreign investors and onshore investors, is their expectation aligned with that? I mean, are we going to see a disappointed investor following the MPC if we do see a more modest package like that?
That's a very good point. So we have a more cautious view on earnings growth, which is more highly correlated with the macro environment. So we are expecting only 6% earnings growth for MSCI China for this year, and followed by 9% next year. We do expect China to gradually come out of deflation at some point next year. But if you look at the consensus numbers, they are expecting 9% for this year and 12% for next year. So they are slightly higher than ours. And if you look at the onshore Asia market versus the offshore market, the Hong Kong market specifically, you do see some divergent performance over the last several weeks. And you actually can see that from the most recent earnings results. Actually, for MSCI China, we're seeing a higher percentage of positive earnings alerts, whereas for the Asia market, it's still more dominated by negative earnings alerts. So this divergence of performance in the near term, we think is likely to continue. But for the rest of the year, we think Asia market will have a decent chance to catch up because, number one, they do have a very large variety of technology-focused stocks that investors can choose from. And number two, global investors' positioning in China, Asia market has already dropped to the lowest level since 2018. So there is ample room for them to increase allocation there. And number three, the AH premium, the valuation premium for Asia versus the Hong Kong market is coming down quite quickly.
It's narrowed
so as it starts to go even further down, I think the relative valuation attractiveness will finally appear.
Okay, Laura, fantastic to have you. Thank you so much for joining us this morning. Laura Wang, Chief China Equity Strategist at Morgan Stanley there. There is plenty more ahead. You are watching The China Show. This is Bloomberg. Good morning. You are watching The China Show. President Xi Jinping's recent meeting with tech sector leaders has boosted sentiment in China's AI industry. DEEP Robotics, a company that focuses on R&D and production of AI robots, told us they're equally optimistic about the sector's growth prospects.
We expect that this kind of machine will come into play of our day-to-day life, either in the life or the working environment. To have a ballpark number, we expect to doubling every year, at least from our perspective, or maybe can go even faster.
We have talked about uses such as emergency rescue, security measures as well. Do you expect the use cases to be extended, perhaps with the popular masses being able to perhaps own one of these robots very soon?
I believe that, as you mentioned, many of these user cases are emerging, and because the technology are getting easier to use and cheaper. So it gives you a expanding quantity of the application potential. However, to really make sense for everyone owning one of these will largely depend on how much progress we can have on the AI side of how it understand the environment, understanding the task, and even performing the task, and reduce the ease in terms of operation and the level of risk that evolve. So I believe there will still a reasonable time from today until a point that everybody can own one of these. But for any of these, the real application showing in the video, probably we can soon see that it pops up in many of these applications as the operator side, they are more proficient on the risk mitigation.
We saw a robotics maker founder, Unitary, participating in this high-profile meeting between President Xi and tech leaders earlier in the week. What do you take away from the signaling of this, right, in terms of policy support? Does it make you more optimistic that the government is going to make this a policy priority?
Yeah, we are very optimistic about the outcome of such a meeting, giving that in two directions. That first, we do have this encouragement in terms of trial in different sectors that the government is supporting, so that we expanding a larger base of application potential. And secondly, that definitely more funding will inject into our research work, so that we can explore a lot more of this edge technology come into combination of our platform that we are working with, so that we expecting a boost in our sales volume, and application-wise, a lot of new stuff will come up in the following months and in the coming years.
And that was Choong, the director for overseas business at DEEP Robotics, earlier on with Sherry and Heidi. Plenty more ahead. This is Bloomberg. Right, welcome back. Now it's time to have a look at what's trending in China, a look really at what's making headlines across social media and attracting some eyeballs online here. So we've been covering how animated Chinese film Ne Zha 2 has really smashed just about all the box office records you can think of out there, raking in over $1.4 billion. That's the most ever for a local production. Now, state news agency Xinhua says that the movie already ranks among the top, or the 25 top grossing films of all time worldwide. But here's the sort of economic caveat here. Our Bloomberg economist, Eric Ju, thinks that the film's success may not actually mean better days ahead as far as the cinema industry is specifically concerned. And Eric is here, of course, to defend his view.
Yeah.
Yes.
I haven't watched the movie, actually. I think it starts tomorrow, I think, in Hong Kong.
You want to remain objective here in your analysis.
I'm sure it's a great movie, but still, we see this as an individual success, just like Wukong last year, the game. You know, I think it's a more sign of the success of China's cultural industry, right? They have more originality, more creativity. They can really make high quality, production in animation or gaming. But I think in terms of the cinema business, I don't think probably it won't be enough to change the big picture, because if you look at box office data last year, it had a 23% drop, I think, in China. And it's not unique only for China. I think if you look at U.S. box office, Japan box office, they're all declining. So I think part of it's a global trend that especially young people, they're more going to streaming short videos instead of going into cinemas. So at least that means you have to make a really good movie to convince them to go to cinemas, right? So I think part of it's a consumption behavior change after COVID. But in China, it's probably reflecting more problems. It's also, reflecting the overall weakness in the consumption. And especially considering, in China, it's interesting that it's probably a sign of the decline of dating economy, because young people, they are less interested in forming families, so they don't really need to date. So usually, going to watch movie, it's a common way of dating. But now, another sign of the single economy, you can say it's a booming of video games, right? You see a very big increase in video industry in China in recent years. It's a very sharp contrast between the decline in the movie industry. So it can be, something. I think a combination of, some global factors and some China special factors. It's combining, to driving the decline in the movie. But we have a really great movie in Ne Zha. But I think unless you have such a movie every month or every quarter, I don't think it's going to change the big picture. Yeah.
And dating picking up.
Yeah. The end of the movie day. It's depressing.
Where have all the rom-coms gone? Eric Ju, thank you so much, our economist there. We'll leave you with a look at the Hang Seng Index just to brighten up your Friday going into this weekend. We'll see you all on Monday.